at Australia's place in the global economy, we must take note of the significant impact of trade and financial flows. It all started with the deregulation of the Australian financial system in 1983. This in turn led to much greater accessibility of Australian firms to world capital markets. In turn, more people were able to invest in Australia. The reduction of protections such as tariffs and subsidies further encouraged Australian manufacturers to export globally in industries with high efficiency and comparative advantage. Also, Australia's switch from a managed flexible pay to a floating exchange rate system further enabled Australia's holistic integration with the global economy, primarily seen from the immediate influx of trade and financial flows. As a result, structural change in the composition of trade and production occurred, as we can see in 1989 to 1990. The rural sector accounted for 23% of exports, services 20%, manufacturing 13%, minerals and metals 33%, and other 11%. However, just over a decade later, rural exports reduced by a whopping 13%, services 3%, and manufacturing 3%. On the other hand, exports in mineral and metals exponentially increased by 20%, equating to 53% of all exports. Not only has the composition of trade shifted, but Australia's dependency on trade, calculated as a percentage of GDP, has also risen from 12% in the 1980s to 23% currently. The total value of exports rose from 61 billion to 298 billion, and imports grew from 59 billion to 276 billion. Dramatic change in the direction of trade for Australia has also occurred in both imports and exports in recent decades, due to the exceedingly alluring demand for our exports from emerging Asian economies, vice versa with our demand for their attractively cheap manufactured consumer goods. Due to the significant amount of protectionist policies still in place in many Western economies, like the EU subsidies policy accounting to €220 billion, Australia has been unable to penetrate Western agricultural markets and thus has been forced to reallocate resources to the commodities sector, which is now thriving from China's inelastic demand. In 2001, Japan became Australia's largest export economy, taking over European markets. Then in 2009, China usurped Japan to be Australia's largest export country, now equating to 55% of all Australian exports. Currently, the EU comprises of only a meager 7.9% of all trade, with the US also falling from 22.1% to 11.5%, a staggering 10.6% drop. While Australia's trade flows have increased substantially over recent years, the rate of growth in financial flows has been much greater, as international businesses have bought Australian assets and invested in Australian businesses, and as Australian companies have increased their overseas investments. International financial flows can be separated by short-term and long-term movements of savings. Short-term movements of savings, also known as portfolio investment, is sometimes known as hot money that moves to nations with the most attractive interest rates, as high interest rates represent the potential for higher returns on international savings. Portfolio investments are considered as speculative funds that aim to make profits by anticipating fluctuations in interest rates and exchange rates, with the purchase being less than 10% of the total entity. Long-term movements of savings, also known as foreign direct investment, on the other hand, is very similar to short-term portfolio investment. However, they require the investor to make a contribution of 10% or larger towards the entire entity or asset. FDIs may include loans that earn interest income, purchases of existing assets, or funds used for the construction of new assets, which is usually associated to transnational or multinational corporative investments. The removal of governmental policies resulted in Australia seeing the benefits of attracting flows of finance in the economy, injecting money to Australian companies through loans and share purchases. Australia saw foreign investments grow as the dollar floated and markets opened, leading to the increased demand for portfolio investments over direct investments. Due to the lack of domestic savings, for many years Australia relied on financial flows from overseas to make up the shortfall between savings and investments, as Australia has always been known as a net capital importer. Since the 1980s, foreign investments into Australia have increased by 45 times, and Australian investments abroad have increased by 80 times. These significant growth statistics outline the importance of financial flows providing capital for growth and development in Australia. As Australia has always had a low domestic savings rate, our reliance on foreign investments to stimulate capital growth has always been essential. Currently, Australia is ranked the 5th largest net recipient of FDIs in the OECD and the 13th largest receiver of FDIs globally, according to the United Nations Conference on Trade and Development. However, this high ratio of foreign investment over domestic savings has resulted in Australia having the highest current account deficit of all advanced economies. To understand trade and financial flows into and out of Australia, we must understand the balance of payments. The balance of payments, also known as BOP, is a record of the transactions between Australia and the rest of the world during a given period of time. The BOP consists of 3 accounts: the current account, financial account, and capital account. However, the financial and capital account are grouped together to form one account. The BOP operates in a similar mechanism to the accounting double entry system, whereby a credit on one account must equate to a debit of the equal amount on another account. For example, let's say the current account received $20 million or 20 million credit. In order to balance out the equation, we must debit the capital and financial account by 20 million. However, there is an account called net errors and omissions, which acts to equalize any statistical discrepancies. Thus, the calculation for the BOP is the current account plus the capital and financial account plus net errors and omissions equals to 0. Looking closer into the subcategories of the current financial and capital accounts, we can further determine where the sources of financial flows are coming from and their impacts on the BOP. Firstly, the current account shows the non-reversible transactions of receipts and payments for trade in goods and services, transfer payments, and income flows between Australia and the rest of the world in a given period of time. The first categories of the current account are net goods and net services. The amount derived by adding net goods and net services together is known as the balance of goods and services. The next category is net primary income, which refers to the earnings on investments. For example, when Australians invest overseas, there is a flow of income back to Australia, representing a credit. The last category, net secondary income, merely refers to the current transfers which occur when products or financial resources are provided without a specific good or service being provided in return, and can include payouts on insurance claims, workers' remittances or repatriating funds, and funds taken out of Australia in the form of unconditional aid to developing nations. The addition of the balance of goods and services, net primary income, and net secondary income is referred to as a balance on the current account. Another way the calculation of the current account can be viewed is represented from the table, as we can see where the debits and the credits of the current account occur. Looking on the other side of the BOP calculation, we have the capital and financial account. Transactions within these accounts are reversible and usually include the borrowing, lending, sale, and purchases of assets between Australia and the rest of the world. The capital account records the balance of capital items associated with foreign aid, pensions, and migrant funds. These may include capital transfers from people migrating into or out of Australia, conditional foreign aid, also known as foreign aid with an agenda, and the purchase and sale of non-produced, non-financial assets like intellectual property. The financial account shows Australia's transactions in foreign financial liabilities and assets. Credit entries represent net inflows of foreign investment in Australia or reductions in Australian investments overseas. Debit entries, on the other hand, represent net outflows. Australia consistently maintains a positive financial account balance, which shows that during each year, the rise in Australia's liabilities to the rest of the world is higher than the increase in the liabilities of the rest of the world to Australia. In effect, Australia draws on the savings of the rest of the world to finance its current account deficit. The five main financial account components include direct investment, portfolio investment, financial derivatives, which include hedging, contracts, and securitization, reserve assets, which looks at the RBA savings, and other investments, which covers trade credits, financial leases, and other accounts payables and receivables that do not meet the classification requirements of the above category. The links between key balance of payments categories can be seen from four relationships. Relationship 1. Current account versus capital and financial account. In economies that operate with a floating exchange rate system, a deficit on the current account must be matched by a surplus on the capital and financial account. As we can see from this diagram, supply for Australian dollars must equal to demand for Australian dollars. Thus, a high level of capital and financial account surpluses will result in a widening current account deficit because of the servicing costs and profit repayments. Relationship 2. Large positive capital inflows on the capital and financial account results in larger negative income transfers on the net primary income account. This is because, regardless of its form, any financial flows that come to Australia must earn some kind of return for its owner, and these earnings are debits on the net primary income account. Financial inflows can create debits on the income category of the current account in two ways: foreign financial inflows in the form of overseas debt, which require interest repayments, and foreign financial flows in the form of equity, which will require returns on the equity investment. The combined amount of net foreign debt and equity makes up net foreign liabilities, which is the primary cause of the CAD. Relationship 3. Low savings level equals need for foreign investment. Australia's historically low domestic savings makes it necessary to attract large amounts of financial inflows to fund domestic investments. And relationship 4. Foreign investment surpluses influence Australia's exports and imports. The positive and negative implications on the balance of goods and services can be seen from this comparison table. Positive effects on the balance of goods and services include high production efficiency and the ability to supply goods and services which used to be imported. Negative effects on the bulks, however, include the required imports of capital goods and imports of raw materials or partly processed supplies. Another impact of financial flows on the balance of goods and services can be seen from this graph of Australia's terms of trade, which is calculated by export prices over import prices times by 100. We can see the trending growth in Australian export prices over import prices that has been pushed by China's demand in both Australian commodities and investments. Thus, from these relationships, we can understand that BOP is an important indicator of the health of the economy, reflecting key features of the structure of the economy and highlighting imbalances in the relationship between Australia and the global economy. the BOP has a significant influence on the confidence of financial markets, investors, and consumers. Therefore, a highly volatile and speculative BOP could result in capital flight. The consequences of Australia's high CAD for the future can be seen from the growth of foreign liabilities, from more financial inflows, thus increasing servicing costs. Other implications include increased volatility for exchange rates from speculative investments, constraints on future economic growth in order to keep the CAD at a sustainable level, also known as the BOP constraint, more contractionary economic policy and fiscal consolidation to increase the domestic savings level, and sudden losses of international investor confidence, thus further compromising Australia's external stability. Economists warn that the high CAD is a major risk for Australia. However, at the same time, it's believed that the CAD is fairly sustainable and is necessary for an economy like Australia's, where low domestic savings makes financial investments essential for economic growth and development. However, seen historically from the Asian financial crisis of 1997, an economy may be able to sustain a high CAD and external imbalances for many years before it suddenly finds itself in a major economic problem.